when you talk about investment property, you are referring specifically to land and or building, right? No, yeah, you may think that building will always include land, but not necessarily lah, because it could be classified separately. So it can be land and building, or just the building, okay? So, or just the land, right, without the building. But it refers to property. It does not refer to machine. It does not refer to motor vehicle, right? It is just land and building, okay? Now, that's one. The second thing is that this land and building, of course, is owned by someone, okay, a company, the reporting entity, right? It could also be to a lessee, okay, which we talk about lessees later on, right? Lessees are people that have a right of use of that land, but they don't own that land, okay? They lease it from someone else. That's what a lessee is, right? But we won't focus so much on lessee now. We will talk about lessees later on, okay? But essentially at this point, just know that the land and building is owned by a company in this case, and the purpose why they are owning it is not to use it. So if it's a land, I don't want to build anything on it, okay? I have no interest on planting anything. I have no interest of constructing anything, right? So it's just the land, okay? And my intention of having the land is so that I can hold on to it while the price goes up, and then I will sell, all right? Or I will hold on the land and I will rent the land out to whoever wants to use the land, okay? So it's for rental purposes. I have no intention to use the land for any other purpose other than renting it out or waiting patiently for the price to go up, okay? Or both, you can have both as well. While waiting for the price to go up, you rent it out. Yeah, this is typical of apartment buildings and all that. Normally, why we buy buildings is we want to invest, and of course we may not want to sell it immediately, but so we earn rental, yeah, but we don't intend to stay in it, right? So there's no intention of staying in the house. When you stay in the house, then you are using the house, right? So that's what we mean by how we define, or how IAS 40 defines investment property. Okay. Now, while it's important to know what is included, it's also important to know what's excluded, right? So be mindful of what are the properties that you cannot apply IAS 40, right? So what are some of these? This is what I've already said. So any asset that you hold for the purposes of using it to, like, for farming, for production, or whatever, for setting up your marketing office or whatever, those are not included in investment property. Those are included under IAS 16, property, plant, equipment. Okay. What about property that you hold for sale in the ordinary course of business in the process of construction for sale? Yeah. So those that you buy often, yeah, buy and sell, or you buy and you construct and you sell, those are not considered to be investment property. Yeah? Investment property here refers to non-current asset. All right. So if you buy property for short-term sale, those are no longer non-current asset. They become current asset. All right. And if they become current asset, they will be classified under inventory. Okay, and that will be caught under IAS 2. All right, so these are assets that you want to look at. IAS 40 will be those assets. Firstly, they must be non-current asset. That means if you want to sell, you don't want to sell it immediately. You're holding it to wait for the price to go up significantly, then you sell, right? And in the meantime, you either leave it there or you rent it out. All right, but it is a non-current asset. Okay, but if you buy property and you just short term, you are going to sell out already, like you are in real estate, for example, then that's not that. It's going to be your stock. Okay, that would be current asset, not necessarily non-current asset. So please bear in mind that. If you are constructing an asset on behalf of, so if your business is construction, right? Those are not included, okay? Because again, those, you are not you don't own the building, right? You are just constructing, you're providing a service. All right. So that would come under IFRS 15, right? This is it will probably be looked at as revenues from contract with customers. Yeah. So so that would be treated as a performance obligation. Yeah. So it's not under investment property. And then if it is owner occupied, then this is IAS 16 is property, plant, equipment. Owner occupied means that the company is using it. This is sort of related to number one. Yeah, this is the same as if owner occupied means you are staying in it, you are using it. So if an office, that means you are using it for your office. The last one is leased to another party under finance lease. All right. If it is an operating lease, then you can classify it as investment property, because operating lease would be similar to renting it out. Okay, but if it is a finance lease, then you would literally consider it to be almost sold already. Okay, so then you don't recognize it as you cannot recognize it as an investment property. So please try and understand what is included and what is excluded under IAS 40. Right. So so when you look at the provision of IAS 40, it talks about, as usual, almost all standards will always look at measurements at 2 points in time. Right. One is at initial recognition. Okay, at T naught, which is the time where you first acquire or construct the asset. Okay. And then subsequent measurement, T1, T2, T3 until Tn. How do you measure it? All right. So the general principle prescribed under IAS 40 is that the initial measurement, so this is quite similar to IAS 16, if you recall, yeah? Initial measurement would be at cost. Okay, so it's quite similar to IAS 16 property, plant, equipment. Initial measurement also at cost. Yeah. And now the subsequent measurement, you are allowed, again, sounds like it is sounds like it's similar to IAS 16, but it's not really similar to IAS 16, because the choice is you keep your cost model, which is similar. You continue the cost model. That means cost less accumulated depreciation, okay? Or you use the fair value model, right? Now there's a subtle difference in the name. One is if you go back to IAS 16, the term is revaluation model, right? Whereas in IAS 40, the term is fair value model, right? Now, the fair value model is very different, right? We will talk more about why is it different, but it's very, very different from the revaluation model. But before I talk about fair value model, remember the revaluation model is you revalue it to its fair value, but increases in the value, surpluses goes to OCI and then end up in reserve. Yeah. If there is a decrease in its value, then you charge it out to the profit and loss. If there is no prior revaluation surpluses. Okay. So let's remember that's IAS 16 property, plant, equipment. Yeah. So the fair value model under IAS 40 is very different. But before I look at that, remember your choice, whether you want to choose cost model or fair value model, again, you must apply it to the whole class of asset. Now, in this case, there's only one class of asset, which is investment property, right? It's already narrowed down to land and building. So it will be only be one class of asset here. So if you decide to cost model, you must apply all your investment property at cost model. If you choose fair value model, then all your investment property must be at fair value. Okay, so bear that in mind. Now let's talk about what is the difference. Yeah, how is the cost model like in IAS 40, and how is the fair value model different from IAS 16? Okay, so first of all, when we look at the cost model under IAS 40, it's quite similar to IAS 16. It's cost less accumulated depreciation. So it's like treating it like almost like your property, plant, equipment. Okay, except that if you choose the cost model, you cannot revalue it like IAS 16. Okay, so if you choose a cost model under IAS 40, that means you are strictly cost model, no revaluation at all. Okay, you cannot do half. Huh? I'm going to do IAS 16 as well, which allows me to revalue, right? So if you want to revalue, if you are thinking of revalue, that means you are thinking that the fair value is important. Then if you have classified this asset as investment property, you must choose the fair value model. All right. What is the fair value model here? Okay, and this is the key difference between the fair value model and the revaluation model. Right. So first of all, you have to revalue it at its fair value, right? And this fair value is very specific because in the revaluation model, you can revalue it based on independent valuer. Okay, but in the investment property standard, this fair value is specifically stated. It says that it must be a current price in an active market for properties of the same location and condition. In other words, it must be a property that is you can buy and sell. There's a market out there. Active market means there are many buyers, many sellers, right? You're not waiting for one buyer. You're not waiting for an independent professional valuer, right? This is market price. There must be therefore a market. Okay, so if there's no market for this, maybe this is a specially designed property, you cannot use the fair value model. Okay, you may have to resort to cost, right? So so if you are using fair value model under IAS 40, it must be based on a market determined value, right? If fair value under IAS 40 using an active market is not available, that means you cannot reliably measure it, then you cannot use the fair value model. You have to resort to the remain as cost model. All right, so that's number one very important difference. Yeah, in the IAS 16, the revaluation model, you can use an independent valuer. All right, you don't have to have it based on an active market. Okay, so there is that key difference, number one. Number two, which is even more significant difference, is the gains or losses. No going to OCI for gain. Any changes up and down of the price, you make a gain or loss, everything hits P&L. Okay, so if your price goes up, you're very happy, it goes in the P&L. If your price goes down, you're very sad, it hits P&L as well. All right, why is that the case? So some of you are saying, how come you talk about IAS 16 is a different thing, you go IAS 40 is a different thing? Well, because the nature of this asset is different. This is now classified as investment property. So if it's investment property, your cash flow is determined by your buying and selling, okay, and of course your rental. Yeah, So as a result, changes in price will be relevant to you, will be relevant to the decision making of the primary users as far as their estimation of cash flow is concerned. All right. And also this will faithfully represent the nature of this property, because this is a property held for changes in prices, appreciation that we normally hope for. Yeah, and therefore, whether it's increased or decreased, it should be reported in the main statement of profit and loss, where the primary users will focus on. Okay, so that's the second important difference. Yeah, the final important difference is that if you use the fair value model, where you need to revalue it, and you need to, the other key thing here, don't ignore, is that the valuation must be done every year. Yeah. All right. So if you remember, under IAS 16, it doesn't say you have to revalue your property, plant, equipment every year. It just says that you must revalue it at a regularity, regular enough so that your fair value does not, your carrying amount does not differ from the fair value too much, right? So those type of asset, you don't expect the value to change that much. Okay, so you don't have to revalue it every year, right? 3 years, every 5 years can already. But if you have an investment property, you must revalue it every year, and the changes in this value hit P&L every year. Okay, if there's any changes now. And the final thing here is, because you are revaluing every year, right? So the value of the property, as in terms of its economic benefit that it generates, yeah, is already captured in the change in the fair value, right? So you don't really need to allocate the depreciation charge anymore. So you don't have to allocate the carrying amount, right? So no depreciation is needed. Actually, it's not allowed if you are using fair value model anymore. Okay, so if you are using fair value model under investment property, all you do is just fair value it every year, changes goes to P&L, done, right? You don't have to worry about estimation of useful life. All right, only if you are using the cost model, where you don't have the active market, right? That's why then you have to depreciate under this one. So then, so that's the measurement, initial measurement at cost, and subsequent measurement, a choice of either fair value or cost model.